Ladies and gentlemen, federal employees, finally, we have some answers on how the one big beautiful bill is going to impact you as federal employees. Because initially, this bill had tremendous things to really gut many of your core benefits. Fortunately, a lot of those things have been taken out. We're going to talk about what didn't happen, but what did. What changes are going to be made to your taxes, what tax benefits are there going to be going forward that are now different. So let's go through some of the most important aspects. Number one, what's not in the bill? Well, number one, basically all the federal cuts. For example, they were thinking about getting rid of the first supplement. That has gone away, meaning the supplement is still going to be around. Also, they were considering going to a high 5 instead of a high 3. If you're not sure what that is, no problem. Don't worry about it. Long story short, your pension, how it is calculated, would be less, and they cut that as well. So that's fantastic. Long story short, all the big federal benefit cuts that they were planning are no longer in this now law, which is fantastic, okay? So that's the first thing to keep in mind. Now, what are the things that actually did make it into this bill, this law? What things will impact you as federal employees? Because this bill, while being hundreds and hundreds of pages long, there's only a few things that really impact you. So let me go over them. Number one, there are some changes in the previous major tax law changes happened in 2017. And there were some changes made then that were not permanent. They were said, hey, they're going to expire by this date. A lot of those changes, however, they are now making permanent, right? For example, they raised what they call the standard deduction. There's a type of deduction everyone could get on their taxes. They raised that substantially in 2017, and they will continue to have those higher deductions for everybody moving forward. That became a permanent thing. There's no longer an expiration date on those. They locked in. Also, a couple other big changes as well is the deductions you can have for your state and local taxes. They call it SALT as an acronym, but state and local taxes. Previously, the most you can deduct on your taxes was about $10,000 of state and local taxes. So for high earners that actually owed more than this in state and local taxes, they actually weren't getting all the deductions they might have had the rules been different. But this is actually going up, where at least until 2030, if you are a high earner and you pay, of course, more than $10,000, you can deduct up to $40,000 of state and local taxes, again, until 2030. So that is one of the changes. Now, one big thing to keep in mind is deductions for seniors. Let me actually move my screen down and show you there has been some major changes here into what deductions that seniors get. Now, when we say seniors, we are talking about age 65 plus. That is what we are talking about, simply because that's who qualifies for these new deductions. Okay, so first and foremost, let me explain here. This chart shows us the different deductions that people can get, the standard deductions that people get on their taxes. Long story short, if you are a married filing joint, and you both, of course, are age 65 plus, you will have the standard deduction that everyone gets. You will get an extra senior deduction that was already on the books for a while, as well as with this new change, you'll get an additional $12,000 of deductions because of this change. Now, if one spouse is 65, the other is not, then you get up to $6,000. And if you're single, you get up to, again, $6,000. So these are extra deductions that you will get moving forward that did not exist before. So if you're 65 plus, that is a good thing for you. Now, this actually created a lot of confusion where Social Security sent out an email that said, hey, because of the changes, very few people are going to pay taxes on Social Security. And people assume, well, that means in this bill, in the one big better bill, whatever they're calling this, right? They are taking away taxes on Social Security, and that's simply not the case. What is happening is they are adding these deductions for seniors, which means fewer seniors are actually going to pay taxes on Social Security, but it doesn't take away the taxes directly. So if your income is high enough, right, then you still will pay taxes on Social Security just the same. But because there's more deductions for seniors, then fewer of them actually will end up paying taxes on Social Security because they have more deductions to be able to deduct away from that income. Now, just so you know, not everyone gets these deductions. You have to qualify for them, and the way you qualify for them is basically when your income is under certain thresholds. So basically, if you're single, you get these deductions if you make under $75,000. If you're married, it's $150,000. Okay, so if you make under those limits, then you can get these full deductions. But as you go over these limits that I just mentioned, then you will get less and less of these deductions until it phases out completely. Now, another big change that happened, let me actually move my screen here. Another big change here that happened because of this law is overtime. I know many federal employees work overtime, and this law does take away some of the taxes on overtime. Basically, per person, you can have about $12,500 per year of overtime that is tax-free, which that is a great thing. But again, this does phase out when your income goes over certain thresholds. Once you basically have income over $150,000 to $400,000, that's kind of the range for single people, right? And then, of course, over $550,000 for married people. Once you go over those ranges of income, then this benefit does start going away. But this change, no tax on overtime, is only set to happen through 2028, and then it is scheduled to go away. Last but not least, well, actually, there's two more big changes that actually will impact some federal employees. Let me go through these last couple ones. Number one, there's changes in charitable deductions, where before you couldn't really give to charity and get an additional tax benefit for doing it unless you itemized your deductions. Now, if you're not familiar with what that means, basically, every year there is a standard deduction that everyone gets on their taxes no matter what. And unless you have itemizable deductions like state and local taxes, like mortgage interest, unless you have enough of those types of expenses to be more than the standard deduction, then you didn't actually get any benefit for giving to charity. However, that's changing, where basically, if you're married, you can give up to $2,000 a year, or if you're single, $1,000 a year to charity. Even if you just take the standard deduction, you can still get up to, again, these limits, $2,000 for married, $1,000 for single, of charitable deductions. And what they call it an above the line deduction. Long story short, it means you can both get the deduction for the charity and the normal standard deduction as well. You don't have to itemize to get the benefit for giving to charity, which is a great, great thing. Last but not least, the other change that's going to impact federal retirees and federal employees is a car loan deduction. Basically, you can take interest on your car loan and help deduct it from your income. But of course, there's lots of rules on how to qualify. Number one, loans starting 2025 and later qualify. You can't make this qualify for anything that was started in 2024 or previously. And there's rules on how much of the car has to be, of course, made in the US. So you want to make sure whatever vehicle you're purchasing actually meets those criteria. And of course, there are income phase outs as well. Once your income goes over certain thresholds, then you no longer qualify. And basically, if you are single, this phase out happens between $100,000 and $150,000. If you're married, it's $200,000 and $250,000, where this benefit starts phasing out and goes away. So that is a summary of all these major changes that are in this one big, beautiful bill. And I'm sure we're going to get more information about how these things are going to actually be applied over time, but I hope that's helpful, and I'll see you guys in the next video.